Hello, everyone. Today we start from the basics of the cryptocurrency market. I get stocks, but how are Bitcoin and Ethereum different? I hear that question all the time. Look at the Bitcoin daily chart on screen. Crypto trades 24 hours a day, 365 days a year. As a rule of thumb, its volatility is often described as about 10 times that of large cap stocks like those in the S&P 500. Today we'll cover the difference between and altcoins, what market cap really means, and why this market never sleeps. Just as the stock market has Apple, Amazon, and Tesla, crypto has many different names. With Bitcoin on screen as the anchor, think in three groups: Bitcoin, Ethereum, and the other 6,000 plus altcoins. Bitcoin is where crypto began. There will only ever be 21 million coins. That hard cap is why people call it digital gold. Ethereum is more like a platform where developers build apps. Its supply is not capped the same way. That is the biggest structural difference from Bitcoin. Altcoins are everything else. Coins like XRP or ADA each chase a different use case. Market cap is current price times circulating supply. Think of it as the market's recognized size for that coin. The same idea as Apple's market cap on NASDAQ. On this Bitcoin weekly chart, read the current price and multiply by 21 million. That product is roughly Bitcoin's market cap. Try the math yourself on the chart. Historically, Bitcoin's share of the whole crypto market is called dominance. When dominance is high, big money is concentrated in Bitcoin. Get in the habit of checking a dominance chart so you always know who is leading the market. U.S. stocks trade weekdays from 9:30 a.m. to 4 p.m. Eastern. Sell at the Friday close, and you wait until Monday morning. Crypto is different. Like the Bitcoin daily on screen, Saturday, Sunday, and holidays, it never stops. 24 hours a day. A Fed decision, CPI print, or breaking headline at 2 a.m. Price can react instantly. On news days, 5 to 10% moves in a single day are not unusual. Opportunity is real, and so is risk. You can get liquidated while you sleep. Keep that in mind. Looking at the Ethereum daily on screen, here are 3 reasons volatility runs so hot. First, the market is still small. The order book in big S&P 500 names is like a deep river. Large orders float. Crypto is often a shallow creek. One big order can splash the whole pool. Second, retail traders dominate more than in U.S. equities. Institutions move carefully in and out. Retail sentiment swings to extremes. One rumor and the crowd piles in, or stampedes out. Third, leveraged futures are everywhere. When people trade with borrowed size, a small drop can trigger a cascade of forced liquidations, forced sells. Stack those 3 together and you get the wild swings you see. On this Coinbase Bitcoin daily, the USD price can sit a little above or below other major venues at the same moment. When Coinbase trades richer than the global average, traders call it the Coinbase premium. Compare charts across venues, and you can see that gap yourself. It usually shows U.S. demand heating up. More buyers on a major U.S. platform than elsewhere, sometimes tied to flows or retail FOMO. The trap. That premium is a thermometer of sentiment, not a free arb. Fees, transfer delays, and account limits eat most of the gap before you can lock it in. Use it as a read on market mood, not as a get-rich-quick arb strategy. That is the practical takeaway. With the Bitcoin daily still on screen, 3 rules to know before you put real dollars to work. First, Bitcoin and Ethereum are closer to long-horizon assets. Altcoins get swept by short-term volatility much more easily. Treat them with extra caution. Second, leverage, borrowing to size up, is a hard no for beginners. This market trades 24/7. You could be liquidated overnight. Third, always check market cap and dominance. Knowing who leads the market right now shapes how you think about direction. This lesson is for education only, not investment advice. Every trade is your own responsibility. Stay careful.